Hello and welcome to the Australian Market Digest weekly video report. I'm Stephen Hogan, your author and regular guest expert on Sky Business Channel and CNBC. Before we get started, let's just have a look at a quick disclaimer. It is really important to please remember that any information contained in this video report is of general advice only. In preparing this video, Novus and myself have not considered the relevant personal circumstances of any person and should not be relied upon for the purpose of making any investment decision. I am an authorised representative of Novus Capital Limited, and the opinions or views expressed in this report are the personal opinions of myself and do not represent the views of Novus Capital. Novus and myself believe the information in this report to be accurate, reliable and complete, but provide no warranties on its accuracy, reliability or completeness. Please consult a licensed financial advisor before acting on any general advice contained in this report. If you are looking for an advisor, please feel free to contact me on 9375 0119 or visit my website www.stephenhogan.com.au and request a free consultation. Okay, so let's take a look at how the markets performed on Friday and for the overall week last week. The Australian market has endured a wild ride in the new financial year, but ended Friday's session and week on a high. Volatility prevailed as local stocks seesawed higher and lower over a week marked by the Reserve Bank of Australia keeping rates on hold and European central banks pledging to maintain low rates and doing whatever it takes. The XJO closed up 47 points or 0.98% to 4841.7 on Friday. US markets were closed overnight, Thursday night our time, so we took our lead from European markets, which were strongly off the back of comments from the ECB. Most sectors were higher on Friday, the best being IT, rising 1.63%, and the worst performer on the day was gold, falling 2.2%. The value of trades was very light on Friday, with only 3.1 billion changing hands on volume of 680 million shares at the close of trade. For the overall week, however, the Australian market registered a second week of consecutive gains as the All Ordinary Index shrugged off major falls on Monday and Wednesday to finish up 1.1%, which was an extraordinary effort. I think I talked about on Your Money, Your Call that the aggregate for the week was around about 8%. So some big moves, aggregate percentage move for the week was around about 8% in both directions. So massive week in relation to volatility. The decision by the RBA to keep local rates at 2.75% on Tuesday sparked the market's strongest performance since 2011. And despite backpedaling 2% on Wednesday, stocks have since regained those losses. The ASX 200, which features Australia's largest 200 listed companies, gained 0.8% for the week and is now up 4.1% for the year at 4,841. Energy companies led the way last week as the sector recorded a 3.6% rise, with Santos among the standout performers. Its shares went up 5.6% following the announcement of a cost-saving alliance with Britain's BG Group. Fellow energy company Woodside Petroleum managed a 2.6% share gain despite cutting its production by more than 5%. Utilities and materials sectors also had a strong week, posting growth of 2.7% and 2.24% respectively, while Flight Centre was among the big winners as consumer discretionary companies rose 2.5%. Healthcare and property trusts each recorded gains of 1.5% for the week, and the financials and telecom services sector both finished around about where they started. It was a busy week for economic news at home and abroad as the Reserve Bank kept interest rates on hold at 2.75% and would have been encouraged by signs of manufacturing pickup, ongoing low inflation and steady house price growth. On the futures market for this morning, the SPI is 13 points lower, indicating a slightly negative move this morning. And we'll just take a quick look at overseas markets now before we get to the analysis. After US markets being closed on Thursday for their Independence Day, they finished the week out strongly, with the Dow closing up 147 points or 1% to finish above the 15,000 level at 15,135. Meanwhile, the broader and more important S&P 500 index finished at 1,631, up 16.48 points or 1.02%, and is now above that crucial resistance level of 1626. Non-farm payrolls on Friday, which was the number that we were all waiting for, exceeded expectations with 195,000 new jobs created. However, it did not trigger a sell-off as the unemployment rate still stayed at 7.6% in June. Now you might be thinking, why would that have triggered a sell-off? I think the stronger the economic data out of the US at the moment, we've seen sell-offs due to the fact that people are dumping stocks because tapering of QE3 is potentially coming with strong economic data. So whilst that new jobs report was really quite strong and could have potentially triggered a sell-off, the unemployment rate was fairly benign there at 7.6%. So interesting figures there. Helping positivity, both April and May's job numbers were revised up, and the chief reason unemployment did not fall was a rising the chief reason for unemployment not falling was a rising participation rate. So people sitting at home who haven't been, their numbers haven't been included in the 7.6% unemployment rate, or 7.5% as it was previously, are now out there looking for work. So it's actually a really good sign that the US economy is now definitely improving, and people who had given up on work are actually out there now looking for it. US indices put in a great performance over the week, shortened by the Independence Day public holiday. The Dow Jones added 1.5% and the S&P added 1.59%, whilst the Nasdaq added 2.2%. Alcoa will unofficially start the second quarter earnings season as the biggest US aluminium producer will report results after the market closes tonight. Profits for the S&P 500 stocks probably grew around about 1.8%. That's according to analysts' predictions compiled by Bloomberg. That's down from a projected increase of 6.2% at the beginning of the quarter. Earnings are forecasted to jump 5.5% for the third quarter and 11% for the final 3 months of this year. And just quickly for the week ahead, economic data being released locally. We have the ANZ job advertisements today. Tomorrow, NAB business survey. Wednesday, consumer confidence, as well as RBA Assistant Governor DeBell speaks. Then on Thursday, we have unemployment for June, and then Friday, housing finance. And overseas, we have US consumer credit this week, US wholesale inventories, the FOMC minutes, PPI, China, and some China economic data on the 9th and the 10th. Okay, so let's take a look at some analysis now and see exactly what we're looking at. I think this week I generally just want to concentrate on global indices. You'll all know the model portfolio and what sort of stocks we're looking at the moment. But there's a lot of concern there, obviously, in relation to how the global markets are trading. So let's have a look at those. And I also just want to have a look quickly at the XCJ, the energy sector, as well as West Texas or the oil price there as well. Okay, so the first indice that will obviously international indice that we'd like to take a look at is obviously the XJO as usual. We've talked about the XJO coming down to that 50% Fibonacci level, so we'll just put that on the chart and we'll just take a look and see where the market is in relation to that. So you can see that 50% Fibonacci level was around 46.14, and we almost barely went down and touched that, as you can see there, and just pulled up short of it, and then got going again, which was quite nice. A few things that we'll notice from the daily chart here at the moment is you'll notice that strong spike in volume here came in at the low, which was also very nice to see. That's what we like to see. When markets put in a fairly significant low, we like to see strong volume come in there and buy it. Volume has tapered off on the way up, which I don't like to see. It's probably an indication that what we're seeing here at the moment isn't going to be a big impulsive move to the upside. It probably tells me that there's going to be some more consolidation here. And I think you'll find with the election coming up that we may just, I think I've mentioned this before previously, is that we may just trade in some sort of range here at the moment. What also was really good to see was when we look down here at the stochastic oscillator, you'll notice that we went to a pretty significant low down here, and then the market went to a new low and the oscillator didn't. Okay, so that's a really good bullish sign here as well. Not so much of a long-term signal, but short to medium term, it was a fairly good sign that we were going to get a nice bounce off that level, and we have. Okay, so I'd expect the market now to trade in some sort of range between 5,000 and 4,600 now for maybe the next couple of months. And then once we see a result in the election, then we could see the market, take off from that point. And also, what could really cause a few surprises here to the upside is reporting season as well. I think expectations are pretty low at the moment. And with the Australian dollar coming down quite nicely, with interest rates down at 2.75%, we could see a few surprises there from some of the manufacturers and industrials, the banks also. ANZ could surprise on the upside, in my opinion, with the Australian dollar coming down. With that growth in Asia and those Asian businesses, with the Australian dollar coming down, that would bode really well for them. So expecting ANZ to maybe just surprise the market a little bit with their earnings. The one thing I would be concerned about with the XJO chart is I did talk about this being an ABC correction, this being the A leg down, and this being a B wave. If we were to get another leg down, like a C wave here, as part of the ABC correction, that would take us somewhere down in here. So that's the one thing I'm obviously concerned about. I don't think that's going to happen. Maybe this was the A leg down, this was a small little B wave here, and then this was the C wave down, and now we're just building a base down here. That's what I'm thinking is happening. So I don't rush out there and sell everything at the moment thinking we're going to 4,300. I just wanted to throw that in there because that is one thing that we obviously need to be aware of. That if this is a B wave, we could have a C wave down. But I do think that this ABC is correct, is complete now. This looks like, even though it's not much to talk about in relation to a B wave, it looks like this may have been it in there. And as I mentioned, we're now building a base. And this base could last, rather than being a correction in price, which we've already seen, this may just be some sort of correction in time now and drag out for several weeks or another couple of months. We don't even know when the election is now, thanks to a change of power in the Labor government, and there's been no announcement in relation to the election at this stage now. I'm sure when that comes, it'll provide a very short-term, maybe bounce in the market here, just in relation to certainty as to when the election's going to be. But as the opinion polls come through up until 4 weeks before the election and then into the election, obviously the market will be certainly hanging by what's going on there, and we'll either be looking for a change of government or a very big change in Labor government policy, a dissolution of the carbon tax and the mining tax, and hopefully some pro-business policy there, which obviously hasn't taken place over the last couple of years. But anyway, we'll play that out as it comes along in relation to the election. So just in summary on the XJO, looking like the ABC correction may now be complete. Volume came in here at the low. The oscillator did not go to a new low whilst the market did, so that's a good sign. We're getting a bounce off here now, but expecting some more consolidation here over the next couple of weeks until a resolution in the election. Okay, so let's just take a look at the Shanghai now as well, because we covered that quickly a couple of weeks back there. So I just wanted to take another quick look at that. Oh. Might just look at a weekly chart on this one. Okay, so I mentioned a couple of weeks back when the Shanghai was up here, I think it was, it just broken through the 50 period moving average, that I thought that we were going to come down here and retest this low. And it looks like that's obviously what's happened there. So we had a massive sell-off in the Shanghai 2 weeks ago, as you can see, and that took it down below that level. And I think that there was around about a 5% move there in one day, which it looked quite scary, to be honest with you. But as you can see there, it's come down to that level, and it has bounced off it. You'll see a long tail on the on that weekly bar there. We may see a little bit more weakness in here, and it continue to come down a little bit. But I'd view this level here, where it found support. I'd view this level as very, very important. Can't see it breaking down below this level, and if it does, we need to keep a close eye on that. Okay, so just go back to the daily chart. Yeah, so you can see that was the day. We had a big fall away here. I think that was around about 5%. Then the next day it followed it up again, big massive move. I think that was even further. That was around about 6% decline. And then as the session went on, the buyers came back in and pushed this up. This is a really bullish candle right here. But preceding days afterwards, there hasn't been any sort of impulsive move here to go on with it. So maybe a little bit more weakness in here, but I view this as a very strong support level, and I can't see it going too much lower than this 4600 level. The next one we want to take a look at is the FTSE. So I guess the obvious thing that's sticking out on the chart here is this 6,000 level. So you can see here that this has been a point of resistance in the past, and probably a very strong resistance. You can see here bounced below it, broke a little bit above it, down below it, went up 6,000 level again, went down below it again, down below it again, down below it again, down below it. Okay, finally we were able to break up above this level, so now resistance turns into support, as Mr. W.D. Gam once told us. And you can see here we got back down to this 6,000 level and we bounced off it nice and strongly. Those ECB comments last week provided really strong support for European markets, and especially the FTSE. And to be honest with you, some economic data coming out of the UK now is actually looking like we're not going to see massive amounts of growth, but it's starting to look like it's on the improve. Rather than falling away, it's looking like manufacturing and so forth is starting to improve a little bit now, which is a good sign. Okay, you can also see it bounced off that 50 period moving average as well. So if we're looking for a real key level here on the FTSE, then we want to be paying close attention to this 6,000 level, in my opinion, because if it was to break down below 6,000, we're probably going to head down back into this region here, where it found support there and found support there. So around about 4,800, and that's a big move. That's that's another 1,200 points down below 6,000. So really key that we hold this level here on the FTSE. I'll just take a quick look at the S&P 500 now as well. Okay, so we've covered the S&P 500 previous week, so I won't spend too much time on it here. But obviously, clear uptrend here at the moment. Higher lows, all in place here. And then more recently, we started to fall away here with the announcement that of QE3 tapering off by the Fed. And we also talked a little bit about last week how we view that as a medium long term actually good sign for the market. Very short term traders will be selling the US market here. If we do get any sort of tapering off of QE3, but medium long term, what we really want to see from the US market is some stability, is some growth. Goldman Sachs, reading their research, they're expecting the US economy to grow at 3/4 of 2014 will be around about 3.5%. First quarter will be around about 3%. So if we can get the US economy growing at around about 3.5% next year, that's a real positive sign. We need to see unemployment come down, and we need to see obviously manufacturing pick up. Non-farm payrolls. Increasing every week. We'd like to see that number up around about 300,000 every month. But this is a really good sign because we're seeing obviously a bit of a slowdown here in China, and them going from more building infrastructure to more service orientated GDP. So what we really want is for the US to provide the engine room for global markets and for them to be chugging along quite nicely, and for them to be to provide some confidence to the world that the world's largest economy is back on its feet again, is doing well, and tapering off of QE3 provides no negativity for me as long as it's done at the right time and the right strategy is put in place to do so. I think whilst Ben Bernanke has been exceptional in his role, the recent comments he's made in relation to QE3 hasn't been the best in relation to providing stability to the market. I would have liked to have seen some different comments there. But I mean, he's been exceptional in his role, and I think we can all thank him for the US economy being where it is at the moment. Whilst they do have quite extraordinary levels of debt, it's no point trying to get yourself out of debt, which some commentators have said, whilst your market and economy is really in the doldrums. And I think he's done an exceptional job. US S&P 500 found support at this level where there was some sort of consolidation last time, and it's bounced off that nicely. Key levels here for the market, for the US market. I don't want to see it come down much further than this 1500 level. I think obviously, and a breakthrough of the 50 period moving average as well. You can see that that's provided significant support. Bounced off it there, bounced off it there, bounced off it there. As a resistance level, it bounced below it there. So you can see, the 50 period moving average at the moment is pretty significant on the US market. So we may get some sort of pullback towards this level, but I don't want to see it break 1500. But US market trading really well, nothing negative on that chart at the moment despite the recent consolidation, and there's nothing really impulsive about this move to the downside. The global sell-off that we've seen recently, especially on the Australian market, in that 4 to 6 week period, we came down over 10%. US markets have actually held up pretty well, so that's been quite good. The place I want to go, well, the next thing I want to look at now is just the energy sector in the Australian market. As you all know, very bullish on the energy sector here going into at least 2017 on the Australian market. So I want to keep track of this on a fairly regular basis for people following the Australian Market Digest and for clients, because we are overweight the sector. We obviously have diversification in the portfolios, but we want to be overweight the energy sector. So we need to make sure that we keep a good track on this market. particular market, which is the XCJ. So as you can see here, found a low at this 11,500 level, bounced off it. Now what we're starting to see higher lows here, higher low, higher low, higher low. Some good volume coming here. You can see there, it went to a pretty significant low there in the stochastic oscillator, and we almost went to the same level here price action wise, but yet the oscillator was quite substantially higher than where that previous low was. So really nice impulsive move here. We saw Woodside downgrade production last week, but only a very small downgrade in relation to some technical issues. And the market responded really negative to that initially. I think Woodside was down 4% the day of the announcement, and then bounced back straight away. I think when we look at Woodside at the moment, with 80% payout ratio and dividend-wise, obviously we're not going to see huge amounts of growth because they're concentrating more on their current assets and providing good returns to shareholders, which is what we want to see in this type of environment at the moment. Once the economy starts to pick up, then we'd like to see them probably pull back on the payout ratio and then start to look for growth again. But Woodside's looking particularly good here for me as a long-term hold. So you can see what I'm talking about there. Let's just look at the daily chart. You can see here we had that big pullback there. That was the day of the production downgrade. I think it was down around about 5%. Until we actually see that in terms of the numbers on the balance sheet and how that's affected profitability, then I think the market had a massive overreaction there. We'll need to see that. The oil price is trading particularly well here. So when we draw down into numbers, it may actually not affect the balance sheet or the profit statement there as well. So you can see there, fairly significant level. This $34 one bounced off there last time, and even more so around this $33 level. And it's bounced nicely off that, and we've got going again here as well. So like to see it back above this 50-period moving average. But yeah, Woodside, it's a medium long-term hold for us. What it does here in the short term, we're not too concerned about. But it's, for me, it's definitely worth above $45 here currently. And then with the dividend there as well, very, very attractive. Okay, so I just want to take a look at, lastly, just oil. There it is there. Okay, so we can see here, let me just zoom out here. I'll just go to the weekly chart because I think it provides a better indication of where we're at. So you can see here, not a great bullish uptrend here, but higher low, higher low, higher low. It's taking off again. Obviously a very messy, slow creeping uptrend, but we're slowly moving in the right direction. And then if we put, what's really significant is if we Okay, so you can see here that we're trading in this big triangle here, basically touching the highs and the lows of the triangle. A lot of messy congestion in here. It got really messy, and as you generally get to the apex of the triangle, it generally does look like this. It starts to get really messy, and then we get a nice impulsive move out of the triangle. Really good sign when we measure out how far this move can potentially go. When we measure from the bottom to the top of the triangle, and then we move that over to here. There you go. So you measure from the bottom of the triangle to the top of the triangle, and then place that at the apex of the triangle to see where the potential move can go. Now, I've talked about oil the last 12 months, and I talked about how I thought by 2015 oil would be back at $150 a barrel. So you can see there, from a technical perspective now, my comments in relation to oil going to $150 was more from a fundamental point of view, in relation to the 60-year cycle, and also knowing how oil trades going into environments, low interest rate environments, where we start to, especially in the US market, where we start to see some sort of hyperinflation, which bodes really well for the actual oil price. And you can see there from a technical perspective now, it's actually starting to play out from a technical perspective that oil can get to that $150 region there as well. So just to recap on oil, really impulsive move out of this triangle now. I saw it break out of the triangle here, then pull back in, and has now made an impulsive move up above that $101 level. And the reason for that more recently is we've seen some tension in the Middle East, more specifically Egypt, which has really pushed the price of oil up. So now what we really should see is a real impulsive move up to this to closer to this $150 level. I dare say we'll get an impulsive move probably up towards 120, some sort of consolidation or correction once we reach that level, and then over the next 18 months up towards this $150 level. So obviously oil looking quite good there from a technical perspective. Then we also have the XEJ looking quite good, the energy sector in Australia. We have stocks like Woodside Petroleum, Santos trading really well. There's some other ones out there that I think look very attractive, such as SXY, BRU. BRU's had a big correction and is very cheap at current levels, in my opinion. Beach Petroleum, all these AUT, all these very attractive-looking oil and gas plays. So what I'll do next week is, now that we've looked at overseas indices this week, we've also looked at the crude oil chart. We've also looked at the XEJ. What I'll then do next week is we'll start to have a look at some of these oil and gas plays individually. Obviously, we know most clients are in Woodside Petroleum and Santos, so we won't go over them too much. We'll have a quick look at the charts and see exactly how they're trading. But what I'll try and get for everyone next week is some of the mid to smaller plays, and see if there's anything attractive out there at the moment. Okay, that's it for this week's Australian Market Digest weekly video report. Thanks very much for tuning in. We look forward to sending out the weekly report to you again next week. If you aren't a client, please feel free to go to www.stephenhogan.com.au and request a free consultation. You can do that on the homepage, as well as there is a free portfolio review page there as well. Don't forget to tune in to Sky Business Channel's Your Money, Your Call on Tuesday. I'll be on the show with Julia Lee, and I look forward to seeing you soon.